Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing our weekly market update. I want to jump right into. There's so much going on. I've got to share this with you first, though. So this is going around, and it very confusing for a lot of people. It says U.S. home sellers are sitting on nearly. Make sure I've got my sound on there. Okay, are sitting on nearly 700 billion worth of listings, an all-time high. So it makes it seem like we've got some crazy amount of inventory. This is what's called clickbait, and it's not necessarily that it's completely wrong. It's just the fact of how it's presented. And what the key factor is the first thing is the amount of homes that are on the market. Okay, uh, right now we're at actually a really good balance, not distressed level. And what I mean is, when we talk about the crash, a lot of times we'll talk about the amount of inventory there was back then, but what kind of inventory was it versus now? So during the crash, we had almost 4 million homes for sale. And most of that was very distressed. So you had like 250 to 400,000 homes per year being, coming onto the market, and the majority of that was distressed, and a lot of it was also people who were losing their homes, and they weren't buying anything else. Nothing else is being eaten up. So typically, a seller 75% of the time is also a buyer. So that eats up part of what that inventory is out there. So one of the big things with that is the fact that you've got to look at it within the context, and that is that the homes that are out there is actually at pre-pandemic levels, which I'll get into more in a minute. But that's a good thing. That's a very good thing, because when rates do come down, okay, when rates do come down, we're going to want that padding there so we don't run into another situation like we did in 2021. Okay. So, this is, again, Redfin's under, new management, new ownership, and they've got, I get it. They gotta sell stuff, right? You got to have the clickbait out there. And again, not necessarily wrong, but it kind of gives the wrong idea when it gets into some of these headlines you see out there and some of the clickbait stuff. So one big thing is this week is jobs week. So what we're looking for is some of the numbers that we keep talking about with the Fed, and that is, the idea that we're looking at what the Fed's looking at, right? Because they want, to see a certain number of unemployment, and that would be 4.3 to 4.5% or higher for unemployment. Right now, we're like sitting at 4.2, and then also the initial jobs claims that we have coming out in our last numbers last month were 240,000. We need to be at 323,000 in order for it to really mean something. The next Fed meeting's coming up June 17th to 18th. And the bond market's usually going to be ahead of what the Fed does. So Powell is very slow to things. We call him too slow Powell. And he should have already lowered the Fed's fund rate, which would in turn affect the mortgage, indirectly, but it would affect the mortgage rates by about, what happens with the Fed affects mortgage rates by about 65 to 75%. Okay, as far as where they are, and the splits between the 10-year Treasury and the mortgage rate. So when we talk about these numbers, though, we got to really look at what it is that's really going on. And so sky's not falling, even though it's great clickbait. The other thing that happened was the Bill Pulte over in the cabinet for President Trump announced that, and President Trump announced that there's going to be this whole thing with Fannie and Freddie Mae coming out of conservatorship since the crash 2008. We had, where it was basically completely handled by the government. This is a good thing. A lot of people are worried interest rates may go up if this happens, but there's always going to be an explicit guarantee. I don't think we're going to see interest rates go up. I think actually this will be a good thing because they got about $7.8 trillion sitting in there right now. And what that means is and stocks shot up. They have been shooting up ever since they've been talking about this. So I think it's a good thing because we're going to see the more money they have, the more opportunities for home buyers to for Fannie and Freddie to basically help with those mortgages. So I see it as a good thing. Now, next, just to kind of move on here, always check out our Facebook page. Also, we have our my whole thing jumped here. Sorry about that. Get to where I wanted to be here. I'm just kind of doing this in a little bit different fashion here because I wanted to show you guys where we really are in inventory too, and that is these three charts. Available inventories back to pre-pandemic levels. Okay, U.S. single-family inventory is at 32.8% greater than last year. Again, this is a good thing because it gives us some cushion when rates do come down. We're going to see, and also application data has been up, except for this past week. But this is a good thing because now it gives home buyers a little bit more leverage. We always talk about affordability. Gives them a little bit more leverage, gives them a little bit more options and properties to look at. Keep in mind that inventory also, 75% of that, give or take a little bit, is also going to be a buyer, right? Sellers are buyers too. So home sales, also another chart here, home sales are now running at 5 to 8% more than in 2024. That's also a good sign. But purchase mortgage applications are definitely up over last year too. So we've seen they're up. Let's see. Let's go on to the next tab. Purchase application data up to date was down 4% week to week, but for the year we're up 18%, 18 straight weeks of year over year growth. That's good. Now, of course, this isn't anything crazy, okay, but it shows us that mortgage application data, in other words, people are going out and getting mortgage loan applications. They're getting pre-approved, and they're out there shopping for homes, and they got more choices now. So that's a good thing, okay? Also, we talked about the Pulte thing. Where was the next thing I had here for you? Oh, geez, it just jumped on me. I'm sorry, guys. Let me get through all his crazy stuff here. Okay. Logan Motoshami says he believes that the new home sales report will be revised lower. However, since 2022, we haven't broken below 2022 lows, and new home sales hitting a multi-year high isn't saying much because we're coming from lowest sales ever. Okay. The big difference though, with the new homes sales, on the other hand, saw a purchase application hit post-COVID highs recently, and their sales reached a multi-year high as well. However, they exist in a sub 6% mortgage market because they're offering all kinds of incentives. Which he's got some funny stuff on here, which, obviously Jerome Powell saying, we've got issues with the Godzilla tariffs that are causing, some of the hold off, wait and see, too slow Powell stuff is this excuse for that. Pulte and Trump have both been saying, hey, we need to get these rates lower. Other countries are lowered. I think, over in Europe, they lowered it 9 times their interest rate. So we've got all these things going on, and they're trying to get Powell to lower the rates because the affordability is just really, hard for people, of course. So anyways, I think that's all I had from here. Oh, the new homes purchase application data is pre COVID highs because the builders are treating the market as a buyer's market. I wanted to point that out because it's really important for, you know, it's really important for sellers to keep that in mind, that if you're going to put your house on the market, obviously the best time to do that has passed, quite frankly. Usually right after the new year, leading into spring is always the best time to put your home on the market. Busiest month is typically going to be in April. Not to say that you can't sell your house now. I mean, putting homes on the market, and as long as they're priced accordingly, you're not going to have an issue. But it's really important to know that we're in, especially in the Phoenix area, we're definitely in a buyer's market. So just something to keep in mind as we go along here and look at this stuff. It is definitely a buyer's market, and I'll get more into that in a second and some of the stats on that. So right now, the 10-year Treasury is, and I'm going to, a little sneak peek here in a sec. If you hang in there, I am going to show you how we're actually going to get lower interest rates even before Powell does anything. And, you know, why we track the 10-year Treasury is because the 10-year Treasury historically is going to be about 175 to 200 point split between the 10-year Treasury and mortgage rates. We call it the slow dance between the 10-year Treasury and mortgage rates. And again, bond market for the 10-year Treasury is always going to be ahead of the Fed. But the Fed lowering the rates will definitely, make a 65 to 75% difference. However, there is something coming up this summer that should give us about a half a point, percentage point, or 50 basis point swing over time in the bond market. And I'll get into that in just a second. But right now we are at 4.3 today at the moment. And private sector hiring, this is jobs week, so private sector hiring rose by just 37,000 in May, the lowest in more than 2 years. So Trump is saying, and Pulte are saying, okay, this, you've broken, you broke inflation. We're down to like 2.1%, close enough to 2. We have the tariffs. We're, lowering taxes. We're doing all these things. We made cuts in the big, beautiful bill, and there's probably going to be more coming in the Senate. That's going to drive a lot of the inflation thing. So, of course, because Congress has the power of the purse, the more funny money they print, the higher the inflation is going to be. They're trying to make major cuts there. Some people want more. People are saying Powell's political. Whatever the case may be, these ADP numbers, a lot of people don't put too much stock into this, but all indicators are that it is a softer job market, and the Fed keeps moving the goalpost. First is going to be 4.2, 4.3% unemployment. Now they're saying 4.5 that they're looking at, and historically it's typically been the idea that you want to lower lower the inflation, then the lower the mortgage rate, the Fed fund rate, and all that. But they're looking at basically breaking the unemployment numbers, which is crazy. So anyway, looking at the actual rates today, these are the average rates across the country. 30-year is what you typically hear in headlines, is 6.87. And how can we get on track before Powell's lowers rates, if he ever does, or before he leaves next, May of 2026? One note on that is you're probably going to see what they're calling the shadow Fed come into play. There's some names in the hopper for that. Scott Bessett had talked about this back in October of last year, where we may have to see a shadow Fed, which will basically be saying, when I get in there, I'm going to be, when we get this new person in there, he's going to or she's going to lower the Fed's fund rate, okay, by big margins. So by doing that, the bond market, you get ahead of the Fed anyway, but there's something else in play here. And I want to show you this. So one thing that came out is Fannie Mae, I think they had some insider tip on this, but Fannie Mae forecasts sharp dip in mortgage rates by the end of the year. But Fed, too slow Powell keeps saying, well, we may not, we may have one, maybe two, possibly. We'll see how it goes, blah, blah, blah. So how are they coming up with this? Well, something that, again, the Treasury and the Trump administration is looking at, Scott Bessent, is preparing to ease big bank rules. And basically what these are SLRs, so supplementary ratio reserves. And basically it's a rule that says that banks have to have a certain amount in reserves because of the financial crisis before. So he says we are pushing to have this supplementary leverage ratio, the SLRs, either reduced or removed, and it will allow banks to buy more treasuries, Bessent said in a radio interview with Roger Stone last week, adding that it will help deliver on his goal of lowering interest rates. He said easing the rule could reduce treasury yields by 0.3 to 0.6 percentage points over time. Okay, so that because they can basically put that money into bonds, which basically means we can now offer that to home buyer home loans, and therefore it creates this ease in bank rules for that purpose. So we'll see how that goes. That's supposed to be coming this summer, guys. So keep an eye out for that. We'll definitely keep you posted. One thing to note right now, again, we are in a buyer's market in most areas, especially in places like Florida, Texas, Arizona. We are looking at a buyer's market. Nearly half the homes, or 44% of homes, are offering concessions. Basically, that means that sellers are, and we see this with the home builders. Like I mentioned earlier, they're in a sub 6% mortgage rate because they're offering all these incentives. So they basically buy down the rate. Where I've seen them as low as like 2.9, 3.9%. They're paying like your closing costs for your lender fees. They're offering other incentives on appliance packages, upgrades, whatever, all kinds of stuff, right? Every builder's a little different. Every area of the country is a little different. But the big thing is the mortgage rates, right? Because that can save you literally hundreds, if not thousands of dollars on your mortgage payment. So a lot of sellers, just resale sellers, are also running into this, obviously. And so when you look at new homes versus resale homes, it's a different market. But for a lot of people, resale, sometimes people say, what's the big difference between resale and new homes? A lot of times it comes down to location, right? So for a resale, you may be want to be closer to a certain area or closer into the center of the city, of the metro area, versus maybe a little bit further out or an area you really don't want to get those incentives from the builder. And that resale home maybe has that, maybe it even has a pool already, whatever the case may be. Location, it comes down to a location a lot of times. Schools, being near family or whatever. So being closer to work. So those are just some factors there. So anyway, just know that that's happening. Okay, that's a big thing right now. Okay, so moving right along, what kind of market are we in here in the Phoenix area? Well, I got to tell you, why is this so gigantic? Let's try and make this, let me get out of here. Okay. So right now, this is the Cromford Market Index, anything over 110 is the seller's market. Anything below 90 is a buyer's market. 100 being completely balanced between 90 and 110 is within the balanced range. Right now we're at 72.9. We are in a buyer's market. Nothing crazy. Okay, not insanely crazy, but a real buyer's market right now in the greater Phoenix area. So just keep this in mind. So right now, people always say, well, I'm waiting on lower rates or this or that. But people move when they need to move, okay, and when they can afford to move. So for whatever the factor is, maybe it's a job, maybe it's family, maybe it's all kinds of different reasons. But they move when they need to move, right? So this is something that's a great opportunity for buyers right now with the concessions, with it being a buyer market. Builders are lowering their prices from where they were. They're offering all these concessions. We're seeing a lot of this in the resale market also, with people having to lower their price to capture more of the market. In people's searches, people are maybe not able to afford quite the square footage that they used to, so they're getting a little bit less for their money. They're a little bit more picky, and they can almost command these concessions, right, to buy down their rate. So just something to really keep in mind. We're seeing, cancellations right now. In a national trend right now, it's running at about 14.3%, where, the people are falling out of contract. In Phoenix inventory right now, we're running right around the 26,000 mark, give or take a little bit on any given day. The condo and townhomes are hit the hardest. Contract ratio on those is down 55% to rate of 21 on contract ratios, which is super buyer market. So there's a lot of opportunities for buyers out there right now. So we see supply, if I can get my head out of there, is a little bit up, and demand is a little bit down. But now is the opportunity. You always do those things. They always say, you want to do the things that other people aren't doing at those different times. When we run into these type of markets. So now is a great time to buy. You've got a lot of choices. You've got all these concessions. You've got people lowering prices. But the price difference, when you look at, for instance, maybe a $10,000 difference in a home with a price being lowered, you may save $80-$90 on a payment. But if someone is giving you, let's say, 1% or 100 basis point reduction buy down on your mortgage rate, I mean, give or take a little bit, you could be saving $200-$300 on a payment. That's huge. Okay. So you take that and maybe you're getting, even more than that. So in some cases, so in any case, it's a great time to buy. And you have to price where the market is at the moment. You can't maybe even look back 3-6 months like you normally would when you're doing comparable sales. You have to kind of look at what, we do this anyway, but you want to really look at and really investigate where prices are right now in the neighborhood, what kind of concessions, were offered recently in the last, couple of weeks. You want to look at, if you're selling a house, you want to look at these things. You want to, I always, call up the other agents. They can't give me exact numbers. They're not supposed to, without the appraisal and the closing in place and all that. But I can kind of investigate a little bit and do some recon there and figure out a little bit more of what is really going on in the now. What kind of traffic are we getting and what? And you've got to price accordingly. You got to price in the proper brackets and the way people are searching and the foot traffic that's in the area. So, key takeaways. Phoenix mirrors a lot of the national trends right now with higher inventory, not super high, but higher inventory, weak demand, cooling prices. They did a recent adjustment of 3.0% to 2.6% nationally for equity gains for this year. Logan Motoshami, who I quote a lot, he had, I think it was 1.7%. And even he's saying, wow, 2.6, that's actually pretty good. And, usually around the country, 2.3 is normal for the Phoenix area. For equity gains, usually we're historically around 5%, maybe 6. So it's just, nothing crazy. And remember, again, with these headlines, people have more equity now than they've ever had. Okay. Most people have, around 300,000 or more in equity. Most, about half of people have their homes paid off. So it's not, it's the affordability is an issue, but it's not the same climate that it was in 2008. We had different lending practices, and the inventory is definitely still way lower without the distressed issue, and sellers are buyers 75% of the time, which back then they weren't typically. So because a lot of those were just foreclosures and stuff for short sales, and people getting out of it and maybe moving on to renting because they couldn't buy after that, bankruptcies, all that sorts of things. So you gotta really keep in mind, can't just read these headlines and think the sky is falling, is the point. So anyways, moving on to my next tab here. Contract ratios. Right now, if I can get it to pull up here, we are, let's see, latest number is right here. So we're right now across the greater Phoenix area. We're at a contract ratio of 31.9. Okay. That puts us well below 40. Okay. And, a hot market's going to be up here in this range. So right now we're just kind of in kind of a warm to cold market, kind of that warm area in the greater Phoenix area. A hot market again would be 60 or higher. So we're just kind of warm right now. Okay. Buyer to balance, depending on your area, it's pretty much buyer to balance in all the areas. So guys, that is all I have for you this week. If you have any other questions at all, please feel free to reach out. But key takeaway here is basically our inventory is pre-pandemic levels. Okay. And, that's a good thing. And as far as all the noise out there, it's a totally different climate with the amount of equity people have and, the credit situation. But we're going to keep an eye out for the Treasury Department, Bassett, and Trump getting ahead of what Too Slow Powell's doing, getting ahead of that this summer. So we'll keep an eye out for that and go from there. We'll talk to you guys soon. Thanks.